I'm Akshat Malhotra. Welcome to the course on the fundamentals of personal finance. Well, if you've been watching all of these videos, by now you're all set with your savings, investments, the right money mindset, budgeting, financial planning, and even taxes. And now it's time to deep dive into mutual funds. Well, have fun watching these videos and don't forget to subscribe to the channel.
In this chapter, we're going to study about the various types of mutual funds that are out there for us to invest our money. We can divide the available mutual funds into three segments. Equity-oriented mutual funds, the mutual funds that invest our money into stocks, shares, so on and so forth. Debt-oriented mutual funds that invest our money into corporate bonds, government bonds, or other fixed income instruments. And finally comes the hybrid types of mutual funds, which are, as the name suggests, a mixture of both, some portion into equity and some portion into debt. So let's begin with studying about equity mutual fund in detail. What are equity mutual funds? And to do that, let me introduce you to this concept of market capitalization. What is market capitalization? Market capitalization is equal to total number of shares into price of each share. So let's go back to the example we took earlier, the bakery example. What were the total number of shares in that case? 100. And the price of each share was 1000. So 100 into 1000, 1 lakh was the market capitalization of the bakery that we set up. Now similarly, for all the companies that are listed in the stock market, this market capitalization is calculated. And then once the calculation is done, all these companies are sorted in the descending order. The one with the highest market capitalization being on the top, right? The top 100 companies with the highest market capitalization form the large cap companies. The next 150 companies from 101 to 250 form the mid cap companies. And 250 first and onwards form the small cap company. I'll repeat this again. Market capitalization is equal to the total number of shares into price of each share. Once the market capitalization of all these companies in the stock market is calculated, all of these are sorted in the descending order with the one having the highest market capitalization on top. Now, out of this sorted table, the top 100 companies form the large cap companies. The next 150 companies form the mid cap companies, and then 250 first and onwards form the small cap companies. Now, any mutual fund that invests your money into the top 100 companies or any of the top 100 companies is a large cap mutual fund. As you could see, a minimum of 80% needs to be invested, which means the fund manager, they also know the importance of diversification, so they can diversify the remaining 20% elsewhere in other asset classes. But 80%, a minimum of 80%, let's say the total amount collected in a mutual fund scheme is 1000 crores. So a minimum of 800 crores has to be invested into stocks and shares of large cap company, and the remaining 20% can be diversified elsewhere. And so that becomes a large cap equity mutual fund. Any mutual fund that invests your money into the companies from 101 to 250 as per the market capitalization table becomes a mid cap equity mutual fund. And once again, a minimum of 65% needs to be invested into these mid cap companies. The remaining 35% can be diversified elsewhere. And finally, 250 first and onwards, any mutual fund that invests your money into these small cap companies becomes a small cap equity mutual fund. Once again, they need to invest a minimum of 65%. And now, how do we go about deciding which one do we need to invest in? So remember the thumb rules with your goal, risk appetite, and time in hand. Now, as you can think, these large cap companies are the biggest companies of India, right? Reliance, Tata, L&T, HDFC. These are the very, very, very big companies of India. And so you could say that the scope of them becoming even bigger could be slightly lesser than the ones that are in the mid level or the small level. But at the same time, the chances of you losing your money are also very, very less, because these are the companies out there have performed very, very well. They have a brilliant track record, a brilliant history. They've been throwing profits every time. So these are businesses that have been built over decades, strong businesses. And so the probability of you losing your money if you invest into these large cap companies is fairly low. And so we could say that the risk of investing our money into large cap companies is low. And at the same time, the returns could also be comparatively lower. Similarly, mid cap companies, they can, if they perform very, very well, they can go up from the mid to the large cap level. On the other hand, if they do not perform well, there is a risk of them falling from mid to the small level. And so the risk is a slightly higher, but at the same time, if they do well and go from a mid to a large cap level, the returns are going to be amazing. And finally, small cap companies, where once again, they can go up to mid or even up to large if they perform very, very well. But as of now, they are at the small stage. So the probability of them not performing well could also be low, right? And so the risk of investing our money into small cap companies is the highest, and the reward is also the highest if they go up to the mid and the large level. And so relating this to the goal, risk appetite and time in hand, whenever we have long-term goals that are there for about 20, 25, 30 years, we could go for small cap companies. Goals that are long but mid-long, if that's a word, 15, 20 years, mid-cap companies. And any goals that are 8+ years where you want to have an equity exposure, you could simply go for large cap companies. That's what the thumb rule says. So yes, you understand the large, mid and the small cap companies and how the equity mutual funds are divided into each of them: large cap equity mutual funds, mid cap equity mutual funds, small cap equity mutual funds. Now, in addition to that, there are 4 more categories of equity mutual funds based on more diversification allowed for the fund managers to do. So the next up is a multi-cap mutual fund, in which the fund manager is allowed to invest a minimum of 25% into each of the large, mid and small cap, and the remaining 25% can be diversified elsewhere, right? So multi-cap mutual fund, in which a minimum of 25% needs to be invested into large, 100 crores, 25 crore has to go into large, 25 into small, 25 into mid, and the remaining 25 into other asset classes. Next comes the flexi cap. Now in this, the minimum 25% weightage has been removed. The fund manager can decide based on the economic conditions, environmental factors, global financial conditions, which sector does he want to invest more into, he or she. And once again, a minimum of 65% needs to be invested in towards equity. That, so that could include in total of large cap plus mid cap plus small cap. So in total, a minimum of 65 needs to be met. But yeah, they need not have a minimum of 25% into each, right? So basically, the division of investing into each of the equity, debt and hybrid has gone away. So in flexi cap, the minimum percentage has gone away, and in total, the fund manager needs to invest just 65% towards equity classes. That can be diversified amongst large caps, mid cap and small cap with no restrictions on the percentage. Then comes the large and mid cap for people who want to diversify their money between large and mid cap companies. So that's another category. A minimum of 35% needs to be invested in the top 100 companies, and then a minimum of 35 needs to be invested in the next 150 companies. And finally, the ELSS scheme, the equity linked savings scheme for tax deduction. In this, just a minimum of 80% needs to be invested into stocks and shares, into equities. The remaining 20% can be diversified elsewhere. It has a 3-year lock-in period as we spoke about, and it helps in tax savings, tax deductions. So these are all in all the various types of mutual funds under the equity mutual funds. Let's now look into the next type of mutual fund, the debt mutual fund. And as the name suggests, these invest into instruments that are generally fixed income in nature. So all the government bonds, corporate bonds, fixed income instruments that we studied about, these debt mutual funds help us invest our money into such instruments. To understand this further, let's understand the concept of maturity. So as you remember, when we were opening a fixed deposit for ourselves, we were doing it for a period of 6 months, 1 year, 2 years, so on and so forth. So this 1 year is the maturity period of that fixed deposit, right? Now similarly, when it comes to government bonds, corporate bonds, many companies take out their bonds. So what really are corporate bonds? Let's take a step back and understand corporate bonds, right? A company needs money and then they would reach out to the market and ask them to give money. They take out a bond, a paper where they'll confirm, where they'll make sure that whatever money they are borrowing from the people, they would return that with an interest, right? And that basically becomes a corporate bond. And similarly, different companies have different needs. Some of the companies need money for about 3 months, some need for 6 months, some needs for a few days, some needs for a few years, so on and so forth, right? So having said that, understanding about the various types of companies that are out there which need money for various, for different time horizons. Similarly, the mutual funds, where the debt mutual funds, when a mutual fund invests into the corporate bonds or government bonds that have an average maturity period of 1 to 3 months, which means let's say a mutual fund invested into 10 different corporate bonds. One of them had a maturity of 2 months, one of them had a maturity of 3 months, one of them had a maturity of 1 month. So when an average maturity of all of these are between 1 to 3 months, that becomes a liquid mutual fund, a liquid debt mutual fund. Similarly, when the mutual fund invests into bonds, government bonds, corporate bonds, fixed income instruments with an average maturity of 3 to 6 months, it becomes an ultra short duration mutual fund. 6 to 12 months, low duration fund. 1 to 3 years, short term fund. 3 to 5 years, medium duration fund. 5 to 7 years, medium to long duration fund, and 7+ years, long duration fund. Now, what does this mean? How does this help us? So let's say if you need to invest money for a period of 6 months, let's say 1 year, and you don't want to take too much of risk, remember the thumb rule. Since it's a short-term goal, you can't go for equity, so you'll have to stick to debt or fixed income instruments. So in such times, you can go for, if you have a 1 year goal, you go for a low duration fund, which has a maturity period of 6 to 12 months. And don't get confused with this maturity by the maturity of mutual funds. Mutual funds don't have a maturity. You can withdraw your money at any time. The instruments that the mutual fund is further investing into, that's the maturity that we are talking about here, right? That's the maturity which comes under the debt mutual funds. Clear? So for us, based on our time horizon, we could choose any of these mutual funds. The one that I did not cover was the overnight fund, which says 1 day, and you'll be surprised what's 1 day fund. So let's take an example here. Let's say Reliance Industries needs to pay Google, I'm just randomly taking names, needs to pay 1,000 crores to Google. Okay. And further, Reliance Industries has to get 1,000 crores from HDFC. No relation amongst these companies, we're randomly taking names. Okay. So Reliance has to pay 1,000 rupees to Google, but Reliance also has to get 1,000 crores from HDFC. But Reliance has to pay to Google today, but HDFC is going to pay to Reliance after 2 or 3 days. Okay. So Reliance says, I don't have 1,000 crores in cash. I think they have, but just for the purpose of example, they're saying they don't have 1,000 crore rupees right now. So what they'd say is they'll take out a bond in the market. They'll ask the public that if you could give me some money for just one day, I promise you an interest rate on that. Simple. Reliance says if you give me some money today, I promise you that within a day's time, I'll return you your money plus 3 to 4% more interest, for example. And that's exactly where these overnight funds come into play, where companies need money for a day, 2 days, or at max 7 days. And then the companies pick up the money from the customers, from the investors, from the end people to give them the returns and further use that money to pay off their liabilities for their operations, so on and so forth. So basically, when the companies need money for a very, very short duration of time. This was just one of the examples. There could be tons of other use cases where company needs money for 1 day or few days. But how does that help us? So let's say, I'll just take another use case. Let's say your friend requested for your credit card and he swiped 50,000 rupees on the credit card. Okay. At the same time, your friend also gave you 50,000 rupees. He said that, I just need to make that transaction using credit card because that has an offer and I will immediately transfer 50,000 rupees to you. So now you know that you need to pay the credit card bill after 50 days, but you have 50,000 rupees today. So rather, why keep it in the savings account or give it to the credit card company earlier in advance? We can earn some interest onto that, right? So you use an overnight fund or a liquid fund and put that money for the next 50 days because that will help you get a little more interest than what the bank would offer on the savings bank or on the fixed deposit, right? And that's how this helps. Now I know, yes, these are very small percentages and wouldn't help, wouldn't make a significant difference with few thousand rupees. But yep, in case you have lakhs of rupees or crores of rupees, these could definitely make a difference. So all in all, that's what debt mutual funds are. Mutual funds that invest the investors' money into corporate bonds, government bonds, other fixed income instruments, and help us diversify our money for our short-term needs. And then finally comes the third category, hybrid funds. Nothing major here. Basically dividing your money into equity as well as debt funds, wherein you don't have to worry about diversification. The fund manager takes care of that. So under hybrid, we have various categories. Conservative hybrid, which has an equity exposure of about 10 to 25%, and the remaining 75 to 90% can be diversified towards debt. Balanced hybrid, 40-60 in equity, 40-60 in debt. Aggressive hybrid, as the name suggests, more towards equity, less towards debt. So 65 to 80% towards equity, 35 to 20% towards debt. Then comes your dynamic asset allocation or balanced advantage funds. In this, just like in the case of flexi cap, you remember, the fund manager would dynamically distribute or diversify your money based on the market conditions, based on the economic factors into other equity classes between large cap, mid cap, small cap. Similarly, in this case, the fund manager could take the decision of dynamically investing into equity versus debt. So maybe right now the fund manager thinks that equity markets are going to perform well. So they could have a major exposure towards equity, let's say 70-80% towards equity and the remaining 20% in debt. And let's say after some time the fund manager feels that equity market might not perform well, let's reduce the equity exposure and increase the debt exposure. So such kind of decisions that can be taken by the fund manager by their own. So such funds are called dynamic asset allocation or balanced advantage funds. And finally, multi-asset allocation, in which the fund manager can invest into multiple assets and a minimum of 3 assets need to be chosen. It could be equity, it could be debt, it could be gold, it could be real estate. So a minimum of 10% needs to be invested into 3 different asset classes. That becomes a multi-asset allocation fund. Clear? So that were the various types of mutual fund, equity, debt, and hybrid. I hope I was able to simplify that for you. And before we end this chapter, there is one important, or I would say a special category of equity fund that we wanted to run by you, and that's called an index fund. And to understand what an index fund is, I'll once again take a very simple example. So I stay in Delhi, and for those of you who are from Delhi, you must have heard of this famous market called Connaught Place. And in fact, if you're in different parts of India too, you must have heard that there is this famous market in Delhi called Connaught Place, right? Now let's say I am a shoe trader and I want to open up a shop in Connaught Place. But before I do that, I'd want to see, right, whether the market performs well or not, whether we have enough footfall, whether good number of customers come or not, whether the existing shopkeepers make profit or not. And I don't think there is any central place which could tell us that yes, in a day the market made a profit of 20%, market made a loss of 30%, so on and so forth. So now if I have to take a decision of opening up a shop, I definitely need to do my own research. And so one way of doing that is I go to the various shopkeepers that are there in that market. I personally go one by one to each of them, take a note of their revenue, their overall profits, their losses, if any. So I go to each and every shop, I make a list of questions, I ask them these questions, get the numbers, do my analysis, and then decide whether I should go open up a shop or not. On the other hand, another way for me to do this is, what if I divide all the shops into various sectors? Let's say all the stationery shops, all the garment shops, all the electronic shops, all the food and beverage shops, all the hardware shops. And now I go to the top 1 or 2 shops from each of these categories and I take the inputs from them. I ask all those questions and do that analysis. Definitely the first method was very taxing, very cumbersome. I had to go for thousands of shops in Connaught Place and then get all of the data and do the analysis. Very, very tough. In this second case, I divided all of these shops into categories and then I went to the top 1 or 2 shops of each of these categories, right? This is definitely easier to do. This is simpler to do. And based on the numbers and the analysis I got from them, I could decide that yes, this market is good, it performed well, it did not perform well, so on and so forth, right? Using this exact same analogy, coming to the Indian stock market. There are 2 major stock markets in India, the National Stock Exchange and the Bombay Stock Exchange. The index of the Bombay Stock Exchange is called the Sensex. The index of the National Stock Exchange is called the Nifty. Now, what is Sensex? From all the companies that are there in the Bombay Stock Exchange, top 30 companies from each of these sectors, could be pharmaceutical, could be information technology, could be finance, could be FMCG. The top 30 companies, 23 companies from each of these sectors form together the Sensex, the top 30 companies of the Bombay Stock Exchange. Now in a day, if the Bombay Stock Exchange performed well, we say that the Sensex had performed well, Sensex went up. In a day, if the Bombay Stock Exchange did not perform well, the Sensex goes down. Similarly, the top 50 companies in the National Stock Exchange form the Nifty. From each of these sectors, that form the Nifty. In a day, when we say Nifty performed well, that's because the companies of the National Stock Exchange performed well. And if the Nifty went down, we say that the National Stock Exchange companies did not perform well. So Nifty and Sensex are the 2 indices of our stock markets, and whether they go up and down tell us how well the stock markets performed. Now, any mutual fund that blindly invests your money into the companies in this Sensex or Nifty becomes an index mutual fund. A mutual fund that's investing your money into the companies in the Sensex in the exact same proportion how those companies are listed in the Sensex becomes a Sensex index mutual fund. And similarly, any mutual fund that is investing your money into the companies in Nifty becomes a Nifty index mutual fund. And this mutual fund, personally, I believe, is great for any beginner who's just starting their equity journeys, who's just starting their investment journey. And the reason I say so is the underlying assumption is that if we feel India as a country is going to grow, India as a country is going to become financially well, then these top companies need to perform really well, right? Only when these top companies, because these are the best companies of India and that's why they've come up in the Nifty and in the Sensex, and if these perform well, these will have a direct relation to the economic condition of the country. And if the country performs well, these companies will perform well. And if these companies perform well, the money that I have invested into these companies will grow, thus helping me get better returns. And so that's why in this particular fund, the fund managers do not put any brains of their own. These are called as passively managed funds. All the others where the fund manager takes a decision are called as active managed funds, because the fund manager is actively involved and they are making their strategies, they are taking the decisions on a day-to-day basis. But for index funds, these are passively managed funds where the fund manager is not putting any brains at all. They are blindly copy pasting whatever is there in the particular index. And that's what an index mutual fund. With that, we complete this chapter on the types of mutual fund. I hope this was helpful. It definitely forms a basis of understanding mutual funds, what mutual funds really are. And I'm sure now that you understand, it'll become easier for you to take decision of which kind of mutual fund do you need to invest your money in. See you in the next chapter. If you have any questions, please add them in the comments below and I will make sure we answer them. Do like, share and subscribe to this channel.